All right, we are back in business. So just a very quick look through some of the notes that I've made on the past election. So I'll perhaps talk about a little bit today. We'll probably talk about a little bit more detail tomorrow, along with central banks.
They can't hear you, but I think that was muted, maybe.
Yeah, they should hear me out this one.
Oh, okay, well then.
You should hear me out both.
Yeah, okay.
Okay. Yeah, so just to cover this week, obviously a pretty busy week and a little bit of variation between order flow and central bank stuff. So you've done a bit of order flow stuff so far. We'll cover more order flow orientated stuff today, but I'll touch on the election. You've then got, we're going to be doing a bit on central banks tomorrow before prep for the Fed, and we'll do prep for the Fed on Thursday because the Fed is on Thursday, not Wednesday, which is the typical of what the Fed is. I hope that's the right order. I've said everything in. Probably not. Right, there we go. Just to bring it up so everyone knows. That's how we're going to go and do it. So, in fact, we'll do more on order flow tomorrow. We'll also have the election, so I'll touch on the election tomorrow. Then we'll do central banks on Wednesday, Fed prep on Thursday, and then you guys can go and trade the Fed on Thursday as well. Fingers crossed it's a good one. I don't hold too much hope, but it's probably a Q&A type Fed, so I'd call it an interpretation Fed rather than a policy change Fed. So it's a little bit of a sort of split up week, and then we'll be finishing off order flow next week, as well as trading events, narratives, all of that jazz. So reasonably busy week. The other thing to mention from a course perspective is extra tab has come up, how to set up market replay. You guys can all set up replay now. Really useful because you can go and trade the 2020 election. Unfortunately, it only goes back to the beginning of 2017, so you can't do the 2020 or the 2016 election, which would have been useful. Well, I say it would have been useful. I don't think you've got such a binary scenario on this one, so I don't actually think it would be massively useful. That was very extreme, the 2016 election. I don't think you're going to have the same this time.
Is the data accurate when you go back that far?
Yeah.
Tick to tick?
Yeah, it trades like a ladder. If you didn't know, it would trade as you would expect it to trade. There may be some variations in some things like DAX, because the DAX used to have a half tick and then they got rid of it. So you may see a couple of little differences there if you go and trade the DAX. The Euro stocks had a half tick for a period of time, and then they concluded that that was rubbish and got rid of it. So there may be some minor variations, but things like the S&P, things like oil, or basically all the CME stuff will trade exactly as it did when whatever the event it was happened.
There goes my life.
There you go. Don't do it. You will learn so much from replay. The best thing you can do with replay is be specific on what you're trying to do with it. One good way to use it is to, particularly if you want to get good at trading events, pick some events. Yeah, payrolls is the easy one because you know it's the first Friday of every month. You know what time it is. Just go and replay a load of them. Don't look at the results. Don't put any weight on the results at all and trade what you see, because you'll get better and better at order flow. The other way to approach it, if you want to try and learn a certain skill, like a breakout type trade, things like that, go and find a load of breakouts in a market that you are wanting to trade and go and trade them. But trade them not from the point of view of, oh look, it's going to break 50, click 49, how great am I? Look at it from the point of view of what you're trying to do is understand how do you actually execute that trade. Also, go and look at a load that don't work, because they're also the ones you need to understand, the ones that don't. I can send over a fair few different exercises. Some of the better ones on there are the ones where, and I've done two variations. I've done one where essentially I tell you where it's going. It's going to go from here to here. You don't know in what sequence. It might go up first, it might go down straight line, it could drift, it could do a lot of things, but you know it's going to trade from 50 to 10. From an order flow perspective, and I'll give you a time frame, which again could be a red herring. It might do it in 5 minutes and I'll give you half an hour. But the whole idea there is you've got to watch the order flow and decide for yourself when to get into the trade. Another variation that I've done, and again I could probably create a few more of these, is to tell you what it's going to do, i.e. it's going to go down, but not tell you where it's going to go. So you've then got to make a judgment as to whether it's gone far enough to get out. I've done that one on one of the examples as kind of a competition, that you've got to make a judgment as to where it's going to reach. And also the onus is then on trying to increase your size quickly, because if you've got 3 targets, If it reaches the bottom, well, wonderful. But if you don't increase your size quickly when you feel confident that this is the beginning of the move, you end up missing out. And also, if it doesn't reach the full like third target, then you're stuck waiting and hoping that something happens. So I can send over a few variations of that, but try and use it in a specific way rather than just going, oh, I can replay, I don't know, payrolls from Friday and I know exactly what happened. Click, how great is this? You don't gain much from doing that. You'll gain a lot more from picking specific things and go and try to trade those.
Profiles up there as well, which I
You can, yeah. If you download Trade8, and I'll show you this in a moment, because what I was going to do is go through month end from the S&P, because I think there's probably a lot in that that will answer a fair few different questions. But yeah, if you download Trade8, when you log in, you can log in and then get the charts to actually move in sequence with the replay. So I think it's particularly good with Footprint, because then, particularly if you're trying to learn price ladder, Footprint's great because it shows you what you thought you just saw, or confirms or discredits what you thought you just saw. So it's a really, really useful thing to have. I'll show you that in a minute anyway when I run through the month end. Yeah, whichever.
Some opening plays are possible.
Sorry?
Some opening plays, like opening drives and
Yeah, well, you can replay any number of them.
project finance stuff.
Yes, very easily. You know, the one on Thursday is the obvious one.
Is that a yes or?
Yeah, there was just open straight down. I think we had one in oil last week as well that did a similar thing. And you had one that opened, traded down and traded up. But yeah, that again is a great way to try and learn. The thing with opening plays though, is you've got a chance to get feedback. Trade every open till the end of the course. Do every single one, or at least pick two markets, you know, something like S&P and oil is good because they're distinctly different times, and trade them. Whatever happens, don't worry about the result, but just say to her, I'm going to do this, I'm going to pick a way of doing it, I'm going to plan it, or I'm not going to plan it, whatever, but trade it, because you're going to get loads and loads of feedback. There's almost no need to replay that, but things like, you know, specific technical plays, you could wait a week and still not see a certain type of play. Or equally with data, you can't trade payrolls when it's not payrolls. So if you want to go and do that, go back and have a go at them. So I'd use it for that. Opens, you don't necessarily need to. Closes the same. But I would recommend closes are a good one for order flow reading to have a go at. Go and have a look at, like I've said this to so many people, March 2020, just replay every close on that month, because there were some spectacular ones, there are some absolute dire chop fests, but you need to appreciate what they're both like, what an absolute chop looks like before you've actually killed yourself trying to trade it. You know, you need that ability to go, this doesn't look good, give it up, rather than just keep trying and trying and trying.
Yeah, if we go to a March 2020 day, and then is it going to be complete, like when we go and trade today, is it going to be completely different, or is it a different order flow but still similar? Like,
It will have a lot of similarities. 2020 was, compared to what markets are doing now, far faster, like lightning fast.
everything's still kind of the same, the absorption, the way.
Yeah, the principle of what happens is the same, because it's still ultimately, this is where people worry about volatility, right? Volatility is the same people doing the same things faster. That's it. There's no new people that turn up when markets get volatile. There's
Bigger ranges, bigger swings.
yeah,
Position size will have to be different management.
yeah, but ultimately, what's going to happen if someone wants to buy, they've still got to buy, and they're still going to go about it in the same way. Maybe if you've got to buy 1,000 S&Ps, you don't go quite so bang 1,000. You could hit that in a sequence of different orders. So you see a prevalence of certain types of things more so in certain environments, but you don't. You know, none of these things go away. Absorption is still the same. Momentum's still the same. It's just
It's
the degree. Precise. Well,
It's not hot.
depends how volatile it gets. You go and look at even S&P at times was single digits in March 2020. You had lots of markets. You know, they would really thin out. The DAX had about a 4 or 5 tick bid offer spread a lot of the time. It was no, it's worth doing. It's worth going and experiencing, because you will experience it again. And if you never do it and it happens, you suddenly have no idea what to do. And when it gets really volatile, markets get even wider. Now, I've seen the DAX with like a 20 tick bid offer spread. So go and have a go. Right, it's reasonably straightforward, because all it's doing is essentially just creating the login. So on your Trade8, when you log in, you're able to just decide whether you go replay or simulation when you log in. So it'll be the same account. The thing you won't be able to do is run your sim account and the replay account at the same time. You'd have to pick one or the other. That is that. Nice and straightforward. I've also, because a couple of people asked about it, where's it gone? up the top, materials section, I've added 2 more hypothesis tasks if people want to have a go at those. So these are older ones. There's also a couple of examples of people's ideas put in there as well, so you can see the way that other people had looked at it. But there's 2 more, the task 2 and 3. The number 1 is the one we did on Friday. So go and have a go at those. They've all got the answers, so don't go rushing through, otherwise you'll see the results. But they've all got all the results on them, so you'll be able to find those below as well. Right. Okay, so quick one on profile. Talking about profile, you talk about the fact that the price comes back to a well-defined area, it's likely to sweep through it, which is previously proved to be wrong. What I'm struggling to get is if it broke that previous accepted area, then clearly something changed. Let's say that sellers are overwhelmed buyers. Okay, I'm assuming that then you hear a large number of buyers who overwhelm them and drive prices back up. Why would the sellers not be interested in selling again at the top of the previous range? Okay, I'll use gold as an example here. This is the sell-off from last week, in fact Friday I think it was. The whole idea here, and you can look at it as this one, I've highlighted this one because this is really, really clearly defined, and so a bit more extreme examples are easier to explain. Right, so you've spent essentially a whole day or a whole cash session trading in this small range, which is the blue box. What's happened there is we've then built up a lot of volume in that area, and that's gone out throughout that whole day. So you've got loads and loads of volume in here. See this as effectively 50-50. Half these people are buyers, half of them are sellers, right? So when the market starts to go up, the people who are sellers are now wrong. Some of them are going to keep on selling and just average and average and average, and that's fine. Some of them keep on selling because they're long from 1,000 ticks lower, that's fine. But of the ones that are actually going to then create further action, the sellers are now in trouble here, and that creates this bid up. Now on the back of that, when you come back here, what you end up with is a situation where, as a buyer, if you were long in here, you've now been proven right. So if you thought it was a good buy in this zone, any move back to it is a good place to buy. And the whole idea of this is that, well, now that you've moved higher, why is anyone going to come and sell it to you down here? If you were a seller in here, you're offside. You're not going to sell it lower than here. You'd like it to go lower, but realistically you don't believe it's going to. And if price is going up and you're a seller, why not try and sell up here now? Don't always think of it from an individual's perspective. Think of it from the point of view of, if you're a larger participant, these are better prices. If you're selling gold because you're mining it, you're not coming and selling it here. When you sold it here and it went up, you're going to try and sell it here or wherever. So these levels get created because the sellers go, do you know what, I'm not selling it down here anymore. I'm going to move my offer up and see if someone will come and get it here, which is what's then happened. So price then moves higher. You then get this double top scenario and market starts to roll back over. When you get back down here, if you're a buyer, and I agree with the whole idea that, well, why not buy the top of that range? Absolutely. And they will. And you do get a bit of a reaction. The first time, it's not crystal clear, but you'll get this when I send these over. The first time it hits the top of that and bounces. Now, if you're a buyer, the buyers took control here. So this is the point where buyers were really strong. The other place that buyers were strong was here. That was where any selling was stopped. Sellers could not get it below there, and then buyers overwhelmed the sellers here. So on that basis, if you are a buyer, you're either going to buy the top of the box for the bounce, and if it goes through there, why are you going to buy anywhere other than the low? And you let it drop and then try and buy it. So what you end up with is this area that's well traded. When you get back there, no one's going to buy in the middle. The only reason anyone's buying the middle of this when it gets created is the fact that they didn't get filled at the bottom. That range is reasonably clear to everybody, and of course if you want to buy, you're going to try and buy the bottom. But if you've got a lot of business to do, you've got a lot of gold to buy, you can't buy the bottom over here and then assume it will come back. It might not. So you still buy up the range, but with less conviction or less force. If people start selling it, then you back off and buy down towards the bottom of the range. So on that basis, when you get back here, there's very little reason to buy anywhere other than either the top or the bottom. And that's why you get those sweeps through. You got a similar scenario here as well. You get that type of move, and then you've also got it just here. So it's a kind of perfect storm for gold, that you had these pockets of volume to trade through, and it's just down, down, down. That's a 15-minute chart. If you put it on to say a 1 minute or a 5 minute, you might see it in even more detail. If If you want to go and have a go at trading something, go and have a go at that. And the thing with these sweep moves as well, just final thing on them. Sweep moves, whilst I often say that they're quick, they're not necessarily that fast. What they are is reasonably straight line. And bearing in mind that this is a very large one, that's what, 350 ticks, just this bit of the move. That's a pretty big move. It's not going to just go click, boom, straight through way through it. I will show you one on the order flow momentum break one where it does. It did about 250 ticks in about 2 seconds. Technical break, just broke the level and swept the whole range. So it can happen, and you have to play it with the assumption that that might happen, because if you don't, it's gone and it's halfway back and you've lost the trade or you've missed the trade. So play it like that, but it's more about the expectation that this is not going to rotate back on you a great deal. It's going to, at least through each phase of it, reasonably straight line it. That's the bit. So yeah, I often term it wrong and sort of saying it's quick. It's not necessarily quick, it just lacks much reversal against you.
Would you say it's even a shift in value? What's so one like straight line?
Well, it's not shifting value. That's part of the idea, that when a market moves, what you get is the market will move and then people either accept value there at the new prices or they don't and it goes back. You know, the example I used the other day, if you're used to paying £6-7 for a pint and the pints in your local pub go up to £10, you've got a choice. You can either pay 10 and accept the new price, in which that creates value and then everyone accepts that that's the price, or no one pays it and they drop the prices back and then everyone goes, 7's acceptable. Quite possibly what would happen if this is a real life scenario is the price comes back here and everyone goes, do you know what, that's a bargain, 7 now, because they were used to paying 6 to 7 over here, and there's your buyers. All the buyers go, do you know what, 7's good enough, because it was scary when it was 10 and now they're happy, and so it then becomes like that and it trades at those prices. Almost like what you're seeing here. Prices move up reasonably swift and everyone goes, well, it's not great. They struggle to push it much beyond here and then everyone's happy when it comes back to these prices and up it goes. Essentially, that's a lot of how inflation works.
When you relate it to the beer, it seems you click a lot.
That's it. Make it about something that is tangible to you and you will understand these things so much easier. And most people understand beer, certainly in England. Okay, right. It's not a silly question. All questions are good questions. If it's full on stupid, I'll say, but this isn't. Absorption examples, it seems you're primarily looking at the orders that are going through at the same LTQ price. Yes, I'll bring up a replay and show you what I mean by this in a moment. Is there any significance to watch out for the orders that go through above green, below red? And then also I've added on a question that I got around, is there a difference between absorption and accumulation? So I'll ping you up a ladder real quick. Yes, maybe not actually always the best one for this. Try and find something that's going to be quick enough and not too quick. So what you are seeing on both of these, you'll see occasionally, there you go, there's a 1 in a blue, or you'll get something in red. Red's down, blue's up. The significance of that is it's the first time that it trades that price after trading a different price. It's not the first time it trades the price. See, just there you saw it. So what this is showing you is that people have now been willing to change price. I don't put lots and lots of weight on that unless either it is a significantly larger clip, i.e., you know, if you're looking in oil here and someone just clicks 40 and it's a blue 40, that's quite significant because that's showing you that, you know, someone's willing to not just test it and buy a bit and see what happens, it's conviction. They're just going to buy it. From an absorption perspective, let's say someone's going to absorb here at 29. What I'm looking for then is the cumulative number. You see that's gone 33, 39, 40. At one price is what I'm interested in, because if people are just hitting and the offer doesn't go away, that suggests to you that whoever is selling is absorbing and they keep on basically just putting the offer back. So let's say they get hit for 5 and then they just add another 5 to the queue. Hit for 5, add another 5. Yes, it's not always going to be the same person, because if I'm in this queue as well and I've got 5, then I might be ahead of some of their orders. So it goes filled, I get mine, they get another 5, they add another 5 to the back of the queue, and they will keep doing that until they get the business done that they want to do. Doesn't always happen at one price. The faster the market, often this will happen over a number of prices. Neither of these are moving particularly quickly at the moment. What it does seem to look like is with oil, we've only just come down here, so this is the profile of the cash session. it's struggling to get back up above here. So the whole idea, there you go, again, it trades 28. You're not seeing any buying. There you go, now you're seeing a little bit of buying. You saw that sort of little surge up, but straight away again, every time they do it, people come in and try and sell, and now they're trying to hit it back down. So it seems that there's a bit of weight in oil here. There you go, you're definitely seeing it now. There's a bit of weight here, and so whilst it's not sort of really, really obvious, they were effectively just not letting it back above 28, 29, and even when someone did go bang, bang and hit it through free prices, it just went straight back. It was like someone keeping a lid on it. Technically, I think it helps looking at where oil is. Yeah, you're just back inside yesterday's range. So I don't think it'd be unreasonable to think this is a good short. This is where you want to use order flow. It's not necessarily about just trying to read everything off this and trying to understand it perfectly. If you want to be just an all-out order flow scalper, you can, but it's going to require a lot of work and a lot of watching. But technically, if you're looking to be short, and yesterday's high was around about 28, 29, there you go. That was yesterday's high. It gets down there. People sit on the offer. Anything that comes up and the offer just comes straight back. They're effectively trying to accumulate a short position on the basis that this can now drop down through yesterday's range, at least towards the single prints, which I think were around about 80. So the whole point of order flow is not to try and trade every little uptick, downtick. It's to be able to say, well, I want to be short. You want it to give you a reason to be short, because you could have sold 28, and if the opposite happened and someone just went and bid 28, it's not going down, and they'll just buy it, hold the gap, and up it goes. So you want a reason to go, okay, yeah, I think it is going down now. Once you're in and you've got the reason, i.e. there were people selling it here, it's the S&P open, that's why it's got busier. There were people selling it here, you've got your reason. You can't just give it up too quickly and go, oh no, I don't like it anymore. You see that, that's just gone up as well, and this is another way of looking at it. That's up above 500 now, that was only about 460 a minute ago. So they've traded another 50, 60 lots at 28, and it still won't go up. In a market that's got 20s on most bids and offers, to trade 50 and still not move it is quite significant. So you're looking at that, you're going, right, I've seen what I want to see. I've seen people selling it here. I'm fine with that. Then it just comes back to your technicals. You've got a plan to stop. Granted, I haven't on this just because we're trying to use it as an example. But let's say you go, okay, well, my stop is 35. That's where your stop is. Unless something dramatically changes, gets above 28, and this would be, and you can argue it the other way, if it gets above 28 and they maintain the bid, i.e. every time anyone sells, the bid just comes back and comes back and comes back, then that's the chance to go up. So if you want to buy this as a gap fill, you've arguably got what you want. You saw it get holds below 28, back above, the bid holds, you can buy that with a stop below the low. If you want to be short, you've sold 28, you're not wrong, but I'd definitely be nervous. And if this comes back to 28 and they keep on buying here, i.e. they can't get the offers down again, that's where I would become much more nervous. So you've got to still have like a range where technically, oh yeah, but I'm wrong there. And then you can make a judgment around 28. So I think from a short, you could be short, you've experienced a little bit of a nervy move back up, but you're not wrong. If you're long, you could have just got in long to play this move up, and now you're sitting there essentially with the view that you've called the low. This is all good. When I say the low, you're not trying to buy the low, you're trying to buy it because you've got enough information to say you believe it is, and your stop's down there. So that's the way that I'd look at that. On the wicking out at the low, or as people say, oh, I got stopped out of the low and all of that. The reason you get stopped out of the low is not because anyone's hunting your stops or anything like that. Often the reason you get stopped out of the low, let's say you're long, you're watching this go down and you're thinking, I should probably get out of this. You don't want to just go whack at market and get out. So as the market starts to move away from you, and it moves quite quickly, you try and hit, but you're not going to hit it with huge conviction, because ultimately you really hope it's going to flick back. So what then happens is you go to click and you end up on the offer. You go to click and you end up on the offer, because it's accelerating. The reason that you sell the low is because the low is formed where the speed going down stops. It gets to there, that's the low, so now it's not falling. It's not falling, well, it's certainly not falling quickly, it's not falling, it's stationary. You can sell that because it doesn't move. So that moment that it sits still is slow enough for you to hit. You hit it, and that you've hit it because that's the low. That's what's happening there. That's why people often say, oh, I got caught out at the low. You didn't. It's just the fact that it slowed down enough for you to click. And that's where people get caught out on the low. Same when you chase a move. If you chase something to the upside or to the downside, you almost always buy the high or sell the low, because that's the moment that this fast move has slowed down enough for you to actually be able to click. Otherwise, prior to that, you're just missing it all the way up. And then by the time you get there, you're in. The other thing on that, and this is why I say make sure you program escape button. Market rushes up and you go click, 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 click. You get filled there and it does that. Now you've got filled, 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 and your average price is here. And now you're panicking. It's one of the worst things that ever happens. Particularly when you're trying to get out of something. You're short, you're trying to get out, and before you know it, you're now long double the size you were short because you've been trying to hit. You're better off just click. If you miss it, click escape and hit again and again until you get there. Right. So that, I think, probably explains a little bit of what I'm looking at there. Yeah, with the blues and reds, I'm not overly worried about. Perhaps more significant in a slower market. I'm trying. Ooh, I just saw one in T-note, but it's gone now. Okay, see, bring in a T-note. Just a moment as I looked there was a blue 1. So someone went click 1, and then it went white 1400. So basically, someone bought 1, and then somebody bought 1400 straight after it. The 1 isn't significant. And also, don't read too much into that being 1700. It's T-note. Yeah, look at the size of the bids and offers. That's nothing. What I'd be interested in here in T-note is, let's say you see a red 1000. That's in somebody's actually taken a proper step and gone and hit it, rather than somebody, there you go, 3. That's not significant. That's, there you go. So it's 3, then someone did 7, and then somebody's hit the rest on that. That's a little bit more significant. And they've come back, and this 17.5 looks like the point where they're just rotating it up and down on that price. There you go, 2 bought, not significant, 1 sold, and then another 1 sold, which is why you've got white. So you're just not really getting that flow. What I'm interested in on something like that is where you see it's 1000 sold, and then almost immediately it goes offered, 1000 sold the next price. That's significant. But 1s and 2s aren't. Much as you probably feel it's significant if you're the 1 or the 2, it's not to anybody else. Right. Okay. Let's stop on that oil. Okay, right. Try and illustrate that. We're going to have a look at the S&P. This was the month end, so I've got just on this chart, which is a static one. This is a 1 minute, and then this is a footprint with 12 rotation, or 12 tick range on it. That's just the final minute there, just that bit. So you've got all of that. You can see the volume that goes through. What we're going to have a look at, because usually a month end will show various different examples of where absorption's happening, where momentum picks up, all of that type of stuff. So we'll go and have a little look at the way that this one trades. This one, I said go and trade it. This is quite an interesting one in that it traded up for about 7 minutes and then it rolled down. So we'll go and have a little look at the way that one trades, what you can see along the way. I'll also show it with a footprint next to it. If you want to get a footprint next to your replays, you need to download Tradeovate. If you download it, then sign in on replay, you can get it to put a chart next to it. Will the replay work on Jigsaw or any other platform that we link the Tradeovate account to? It will definitely work on Jigsaw. I don't know if it works on anything else. That's always been the way we've done it, is Tradeovate will feed Jigsaw and Jigsaw will do it. Incidentally on that, and I'll show you what I mean here. When you set up Tradeovate, when you log into the replay, it will allow you to set the time. Jigsaw, when you log in on replay on Jigsaw, will also give you this little box where you can put in whatever times you want. So if you're not using Tradeovate, you can control it from here. The Jigsaw replay box here overrides Tradeovate. So if you log into Tradeovate and put in whatever time you want, you can then change that on Jigsaw, and Jigsaw is the one that kind of overrides, and that's the one that essentially tells Tradeovate what to do. What I've got here then, I'm hoping this is going to play all right. This is month end, so I've started it from Q2. So this is the beginning of the move up, and then we'll see what happens. I can't remember the exact prices that it reached up to. I know that the move down was 47s to somewhere mid 30s. Can't remember on the move up. Right, up, there you go. It's moved itself. Right, there you go. So this is just the beginning of that move up. So I might at times sort of skip it forward a little bit.
770 was the high on in that.
Push 770. Okie doke. Right, so one of the things you can see straight away on the footprint there is that 700 by 800 by 500. So what's going on is you're getting to absorption at 62 here. You see every time it trades there, got filled, and they kept on coming back, which is why you're seeing there's 1,000 lot traded at 62, and that was all sold into the bid. So that then becomes your, for me, my kind of point of reference. If you get above 62, you can then play this towards the upside. At the moment, it would seem that whoever was buying has been overwhelmed there. They basically bought what they want, job is done, market can now go down. So there's not loads and loads going on at this point in time, but I'm then going to sort of use that as you're looking down at 61, it doesn't seem to want to go below 61. The 62 is then, for me, the kind of main reference. Why is it not letting me click? Don't know why it won't let me do that. Oh, don't know what that is. There we go. Right. Okay. No, it doesn't seem to want to let me do it. So maybe stop. No. Okay. Doesn't matter that much. I'd always try and remember these. You don't have to try and remember it. You can write it down, whatever you want. But 62 is now important. The other area is 63 and a quarter. You've just gone up there and you traded 6 by 58 and then won. So there's very, very little trade at that point. That's important because what that's showing you is that's the point where the buyers have taken control. So what I'm now interested in is whether you're seeing any further absorption on the move up, i.e. holding the market higher, and whether you get any of these phases of momentum in it. At this point in time, it's reasonably just steady bid. I would suggest is just tick, 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 tick up. You're always going to get some degree of rotation. Yeah, it's the S&P, it's not a super thick, super slow market. So one of the things you have to learn with whatever market you're trading is what the kind of rotation is within it. That's just a case of watching ultimately. The other way that I'm looking at areas where you're starting to see absorption or accumulation, however you want to term it, is where you start seeing these builds up in volume. What I'm looking for then to move away from that is a degree of acceleration in the movement. When I say acceleration, what I'm looking for is the buying to be hitting the offers and the bids chasing it up. And what I don't want to be seeing is this sort of two-directional stuff. So you've just gone up there, reasonably steady again. When it moves up, it's moving up quite nicely in the sense that each time it moves up, it just hits the offers out, bid comes up, hits the offers out, bid comes up. So if you're long from down mid 62, I'd be feeling reasonably happy about that. I wouldn't see a great deal of reason to not be in this. 70 is a level, so if you're looking for a target, fine. If you're looking at this and thinking I've got the direction already, then you have to stay in and you have to say, well, my stop is at least, I think, below this area, 65. And if you go below 62, then it's all change. At this point, I wouldn't see that there's too much to make you change your mind. It's basically now just rotating between 69, 3/4, 67. That's the area that it's just sort of rotating in. And sometimes there isn't a great deal going on apart from there's clearly a degree of buying down here, but it's not sort of an obvious absorption as such. And it's struggling to push up there. I guess the difference, if you will, if you're trying to sort of draw a distinction, is when you're dropping down 67, you're getting a lot of volume done. Yeah, they've sold about 885 plus 365, so what's that? 1200-ish, a bit more, 1250 sold into the bid, and only about 500 bought into the offer. So what that's showing you is people are selling it, and they're getting nowhere for it when it trades 67. Whereas on the upside, it just runs out quite quickly. It's far lower numbers up here. So what that's sort of suggesting to you is people are not piling in at the top, or even if they do, they come and buy and no one follows them, so people don't move their bids up and hold it up there. The way this helps is if you come down and that buying stops, that kind of volume, and it just sucking the life out of it at 67, if that stops, then it can break. On the upside, you need the bids to actually follow up and stay up there and hold it. And if you don't get that, it's not going to progress. It's just going to be the same again. People come and buy and then they realize no one's with them and then they run for the exits. That's how I try and interpret that. Okay, so on a footprint, I've got that on a 12 at the moment. In fact, actually, sorry, that's on a 10. Most of the time I would use an 8. This is month end, so it's a bit busier. So really, with the S&P, I'd vary it between about 8 and 12 most of the time.
Right.
Yeah, on the range, on the footprint. There's no specific rule. Do what you think is most appropriate. Vary it however you want to make a fair bit of sense. The thing with a footprint that I don't want to be doing, and arguably, I'd put this on 10 because when it gets busier, it's more significant. What I don't really want is essentially, if you look at that one there, it's basically just a volume profile. You can see where all the darker color is down here. What it's showing you is basically, if you drew it as a volume profile, you'd have a profile like that. It's doing a lot more volume at the bottom. I'm not that interested in the volume profile. I don't need that. I've got a profile, and I don't want a 1 minute profile. What I want to be able to see is the points where there has been reasonably limited trade. So areas like here, which is where we've done sort of 70, 80 lots, and the areas where there's lots of trade and distinctly biased one way, i.e. here, that's 62, whereas 1,000 lots plus into the bid and the bid holds, versus much less 600 into the offer and the offer gets broken. That's what I'm interested in. So again, there you go, it goes up. Someone tried it, they've hit 245 into the high, and then again, hit it into the high. Are you getting any follow through? And straight away you don't get it. So now you've got this quite clear range starting to get established. Let's see if I can widen this for you. Make it a bit more visual. Oh, sorry, just. There we go. Okay, that's a bit better. Oops. Right, so what you've got there then is once you got back below that 16s, you're now seeing much heavier selling. You're getting the orange on the footprint, which is showing you basically sellers are hitting into the bids and you're not getting any counter trade. That's now set the tone that if you think it might be going down or you fancy this to be a sell, it's looking reasonably good. And I'd say then, as long as you're below 67, this looks like a good sell. There's 62, that was the key level before. So if there's going to be any more buying, you want it to come in there. You want them to try and hold this in the face of some pretty dramatic selling. So there you go. Straight away it goes offered, the offer holds. Don't seem to be able to click it, which is quite frustrating, but there we go. So the offer holds. If you want to sell it, this could be your chance because that's the place where people were holding it and holding it and holding it before. This time they've come down. There was definitely some more trade there and then straight away it's offered. That's significant. That's shown you if you had any wondering about whether it's turned, that's it. So it's done that bit. Now it's just a case of what you're looking for is what I would call is sort of steady selling. And that's what you're getting there. You see as well, absorption at 58.5 on the offer. So we got it offered, traded back, there you go, done 940 there without it ever showing more than about 60 lots. That's significant because this is the kind of pressure on the market. It's not letting it back up. From a month end perspective as well, I think really from 62 and certainly from 58.5, your goal now is to be trying to get short. You could sell 62, you could sell 58.5. And the way that I'm then looking at that is rotations back. I want to be looking at this again as a place to try and sell. That's my zone to sell. And then I'm always trying to think from whenever I'm looking at just mainly a price ladder, where are the rotations? It's got through 58.5. Any rotation back has been capped here. It's sticking around 55.5. So and you then start to see it building out the volume here, which is the other thing you kind of expect to happen. It builds the volume. In terms of where you're going to add on, you either wait for it to come back and you can get an offer in up here, or you're going to try and sell it on some momentum through the low. So if it accelerates through the low, you can try and sell more. If it doesn't, then you wait for it to come up here. What you're looking for is it to do something like this little pocket of low volume. Does that, that's a good indication of momentum, of sellers taking control. Until you get that, you can then, you should be leaning more towards a sort of passive sell. Wait for it to come up, and as long as it stalls on a bounce, you don't want to do anything. There you go, that's what you want. So you're then looking to try and sell 52.5. It's done that surge down, which is exactly what you want it to do. Sorry, I'll just try and make this a little bit more visible. The only problem, Trader 8 does not like being knocked full screen. Sorry, there we go. That should keep track with the price. So what you've got there on the footprint is, like I said, it was trading in that kind of 58 area. It didn't really ever come back up there. Much sort of steadier sort of push down. But you saw all the time sort of accumulating volume, accumulating down here. When I say accumulating, it was pushed down and then it's stuck at the low, and then it gets pushed a little bit further and it sticks. The break, and this is the difference, rather than it just being kind of pressing, it's like weights on a trapdoor. Eventually that breaks and people try and hold it, then they try and hold it slightly lower and slightly lower, then they get done. That's that surge down. People call it an imbalance or zeros. Doesn't show it on Trader 8, but some platforms will show that as zeros, i.e. absolutely nothing traded into the offer. It was just bang, 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 straight through all the bids, down you go. So that's a real clear sign. 54 to 52.5, there's your new resistance. So you're now thinking, you're not getting filled at 58.5. You don't want to get filled there. If you get filled 58.5, this is a horrible choppy month end. You don't want that. So you're now sort of thinking, right, I need to try and sell it below there. That's now the sort of step forward. Excuse me. The other part of it as well is keep your eyes on the time. At this point, you've got 5 minutes to go. So if you've sold 62, 58, you tried to sell somewhere in the 52 area, you're going to have an average price of, I don't know, 57, something like that. You're probably feeling reasonably good about this. You don't want to give that up. You look at the clock, you think to yourself, right, I've got 5 minutes. Hold this, hold this, hold this. What you also don't want to be doing is piling in more size too heavily. As in, if you've sold 3, what I don't want to do now is sell 3 more through the low. You're better off to sell in the same increments all the way down so that you don't suddenly rip your average price down. That's where you'll start to panic. So at some point, it's probably going to have a rotation. You have to keep that in mind, probably. Some of them it might not. Some of them it might just, the perfect ones, it will just straight line all the way down. So what I'm looking for then, this is going to be my main reference, the sort of 53 area. If it gets back there, wonderful. You can try and have a go at selling that. The other area you would have looked at is here, the sort of 50. It's not really done that. So there's still always got to be an element for a price there. You watch it trade 50, does it stick at all? And it's not really stuck at 50, it's just gone straight through it. So now the next one is 53. What does it do here? You see it's gone 52.5, 53. At the moment, it's not filling that volume in, so you're all good. And this would then keep you short on the trade. Particularly if your average price is 57, somewhere like that, you're not going to be under any pressure when it's trading 52. You shouldn't be, so don't sort of feel under pressure on it. Yes, it's going to bounce back, but it's shown direction. This has come from 70s already. You've still got 3 minutes to go. There's time in this. There's still time to go, so don't worry about it trading in this area. This is basically now just building up positioning. So think about it like it's a much shorter version of a market trading in a range and then breaking out. This is just doing it on a minute by minute type of time frame. So we've gone down again. You see in every one of these ranges, the volume keeps getting put towards the lows. So you're now looking 48.5. What I want to see through 48.5 is something very similar to what you saw through 54. So you still be looking at that thing. That's fine. Sell it somewhere up here. If you can get in more up there, wonderful. What you don't want to do on month ends in particular is go and try and bash it through the low, at least not preemptively. I'd far prefer to see this trade 46 and sell 46 than I would see it trade 48 and go, this time, sell it. Because if you still keep getting the same game again here, you could just be ending up basically dragging your average price down. This is giving you the chance to try and sell it up here. You still see, you watch there, this is the bit where I'm looking at absorption. It cannot get above 70. So you're seeing there's definitely a willingness to try and sell there. Back towards 52, 53. This way, you think you'd rightly be a little bit nervous, but it's not really trading through there. It's traded up, quick up there, straight the way back. So you always have to kind of go, don't panic it. Definitely you don't want your stop to have been 54. It's not traded all the way through this area. If you look at where it's traded, it's basically traded the top. That's absolutely fine. What you've now seen though is, again, there's very little trade there. So what's happened is you've traded up 54. That was the chance. If it was going to go up, you would have wanted to see the volume that you were seeing down here, up here, and it stick there. And it went there for, I don't know, 2 or 3 seconds. Trade there, trade there, trade there, back. And it comes straight back through that same area again. So once it's done that, I think you should feel pretty confident now. That's a chance to sell more. Granted, you probably would have sold 53 on the way up as it came up to you, rather than sitting there going, oh, I'm going to wait for it to do this and that. Because if it didn't do that, you'd miss it if you didn't sell 52 and a half, 53. So you're going to have to have a go at selling that, which still won't move your average price that much. You're now 90 seconds from the close. So you now want to get into the kind of thinking about, right, well, what more do I need to see here? Ideally, you want to see it through 47. The worst case scenario now is that you're going to have a close that sits here and chops this. That's going to be horrible, because then you've got to give it the time, I would say, until about 59.30. If it just chops this until 59.30, I'd then start putting my bids near the low and just seeing if it would chop me out, on the basis I don't know that it's got enough in it. I'd put some near the low, I'd throw some bids below the low just in case it does flick down, but I wouldn't be looking to hold for much longer. If it breaks 47, then it becomes much more one where you're going to try and hold this right to the close. So there, like I said, there is an element of time watching on this, but it's also the what it does. You don't want to see it get stuck here again. That's going to be horrible if it gets stuck there again. So there we go, it starts coming down, has a bit of pace on the drop. You're interested now, can it get up off the low here? Every time it ticks up, every offer comes straight back. You see, they start getting quite thick. It trades the offer, ticks up, instantly slaps back down, and then straight away, every time it moves lower, they take out the bid, the offer drops, and again, the offers start getting bigger and bigger and bigger now, which is also something that you'd want to see. You always get this on closes. The offers will get bigger and the bids will get bigger. All of the liquidity gets more and more into that close. Once you're seeing that, they're pushing it down now, and you saw it particularly from sort of 49, that anything that trades into the offer just comes straight back. And when it sells, they sell it into the bid, clears the bid out, and straight away an offer comes and fills the gap. And that's that kind of what I call sort of heavy selling pressure. It's just relentless step, 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 step. That's what you want to see. This is the point where you can then add with the momentum. Don't worry if you miss it. If you try and sell 46 and you miss it, don't worry, because it'll often tick back. They'll trade 46, offered again. And so you're basically just adding to the weight on the way down. It's gone through the 47. You'd be very happy to sell this now. you want to be quite aggressive on the sell. You see them chasing and chasing and chasing. So you've got to be pretty quick at this point in time. And then you've now got the bounce back, 42s. And you see there, the volume done. Sorry to pause there. You've got loads and loads of volume done at 41 3/4, which is just in here. I don't actually think that TradeAbout's showing the full amount, because that's showing 1,000 by 1,200. That's done nearly 6,000 lots there. So unless it had already traded down, it hadn't traded down there today, it's done more than that. But it's done that. You're getting a bit of a bounce back towards where this volume is. You've got 30 seconds to go now. This is the point where I definitely start placing bids at 41, because you've traded down there and back, start to reduce around here, just in case this turns into a sort of final chop zone. Once it breaks, then back to the same idea, place bids further and further down the page, and then you've still got 10 seconds. This is why you need to then start exiting in the last few seconds, because you'll get this sort of chop, chop, chop. I'd always leave something right to the end. That was, you've just gone past the close. It didn't shoot down. So when it doesn't shoot down at the close, then you want out, 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 out as fast as you can. That's what well worth going and having a replay of that to try and get, put up, what I would suggest is put up a big S&P ladder and a micro one, because you've only got 3 S&Ps. Do it with a micro and try and add in sort of clips of, you do it either in 3s or do it in 5s and try and build your position. The goal being not, oh, can I get 30 on? The goal being, can you get in and keep your average price above the current traded price so that it never comes back to you, which you can do if you're steady in the way you enter. If you just pile in, it's going to come back on you. Or if you go, sell 3, tick, 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 down, sell 15, it's going to rip your average price down. So try and sell it steadily on the way. The other bit is getting your exit. Try and make sure that you can get that exit. And the way that I would generally do that, Don't be precious about it. Ultimately, just get bid and then pick increments down. Just bid, 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 and see how it goes down and fills them. The advantage of doing that is if you can see that you keep not getting filled 34 and a quarter, and it feels like it gets near and it doesn't fill you, well, that's telling you something. People are buying it there. Be willing to just move that up and buy and get out. But you see the volume it does. That's 11,000 at those two prices, despite the fact it was there for about 2 seconds. So you get an absolute mountain of volume goes through at those kind of prices. So well worth having a go at. If you want a bit of practice, if you did it on all of the ones this year, because we've been in roughly sort of similar type of environment most year. Yes, we've had little phases where there's been higher volatility, but broadly it's been quite sort of stable levels of volatility. So most of the month ends are all going to be reasonably similar. This, I think, I'd put this up there as one of the best of this year, which I don't think was a massive surprise based on the volatility that had preceded it. We'd had quite a lot of movement in the days before, and on the day, this was probably always going to be a slightly better than average. But these are getting really good, these closes. That's done 35 handles. I remember 2013 when we really got into starting trading closes. If you got an over 10 handle close, that was amazing. It was the best thing that you'd ever seen. Like a 6 handle close, you'd be happy with. Oh, you could make your month on a 6 handle close. 24 ticks worth of movement, and that could be your month done. Now you look at that and you think 35 handles on a close. That's everything you would ever want. And there's some bigger ones, like say go back to March 2020, I think there's a couple that were 70, 80 handle closes. Bearing in mind the S&P was trading 2,000 something. So it was doing, what's that, 3% on a close? So worth a look. If it does that much in 10 minutes, you could really get your size into it. I'll show you on this week or next week.
Into this day, month ends are still in play, right? It's pretty up.
Month end will always be in play because it's a situation where people have to do something. It's one of the few times where people have business to do. The other one is option expiries.
This weekend, is options
Option expiry, it's the 3rd Friday of the month, so next, but equities at least. Other markets.
What's that quarters? Does that tie in with month?
The quarterly options.
Well, no, quarter, sort of like
quarter
wrap it
ends.
all in together, yeah.
Generally, quarter ends a bigger deal than month ends. Not by much. I don't think there's a huge shift. I would say that the level of volatility trumps whether it's a quarter or a month. If it's a volatile month, this I reckon was a bigger month end than September or June. So the what's happened recently is more important. But yeah, definitely a quarter end is pretty significant.
I'm guessing in the financial year as well.
Sorry?
In the financial year as well.
It depends where you are, because financial year ends in different places at different times. Like your financial year ultimately depends on your company rather than your domicile. When your tax gets paid, it's different. Like, so the UK company tax is the end of October. It might be similar in America. So there could be something in that in the October one, but I can't say I've seen that seasonality, so I don't want to be like, oh yeah, watch out from October closes. I would say it's more coincidental that October is generally one of the busier months in the year. I've always been of the view that September, October, November, if I could pick 3 months, they'd be my 3 months. They seem to just get a little bit more going on, and if you're ever going to get a sell-off, it seems to be then. I have seen stats that I think September, October has the greatest probability of sell-off, more so than any other month. But yeah, that depends on what's happening. It's coincidental. Equally, in recent times, February and March are the 2 months in the last 5 years. Right, that's kind of a bit on order flow. We could probably come back to a little bit of it in a minute as well. Something else, if you want to go and use your replay, is go and have a look at the US elections. Now, this is the 2016 one. Obviously, you can't go back and replay this one. The thing that is worth a look at is the European Open and the US Cash Open. Those two are arguably just as important as the election itself. I think even more so tomorrow, because, well, I don't think there's a clear direction or a clear winner to be had. In terms of movement, 2 a.m. seems to be about the time to move, so people are thinking about trading it. You've got to get to about 2 a.m. before you can be too confident of any kind of direction. I think this one's going to be less about direction and more about trading state by state. You know, that one's a winner, therefore it leans towards Harris, it leans towards Trump. What's going to be or what it will be akin to, in my view, is quite similar to cricket betting, where you get overweighted opinions on the match result based on a wicket being taken. As if someone takes a wicket and it was, all right, the other team's going to win, and the odds can swing quite significantly. That's the thing to watch out for. The other thing you've got to watch out for is the reaction to one looking like they're going to win or not. I don't think 2016 is the greatest example. But the other point that I wanted to make, and I talked to you guys about this earlier, the post-election rally, this is the election and then the move until the contract close, which is roughly when everyone goes home for the winter anyway, or for Christmas anyway. And basically, it's a steady rally. 2016 was a bull market at the time. 2020 was as well. And 2020 did the exact same thing. There's the election, and then it drifts to the close. I wouldn't rule that out. I'm not saying it will happen, but I'm reasonably confident the S&P will trade 6,000 before Christmas, once the election's out of the way. That's what I think will happen. Right, the thing that happened last time, and I think this tells you a lot about this election, is last time, this move was the move where the odds shifted to Trump. So you had a period in the night where the odds shifted towards Trump winning, and you got that rally. Generally, the perception was Biden's not great, and people didn't like Biden. This was the European Open when there was then the announcement about the postal votes and that Trump probably hasn't won, and you get the sell-off on it, and then you get the reversal. So I think it's going to be one where you get this sort of constant to and fro type flow. That was by far the cleanest move. That was 2:45 a.m. UK. So whatever time that works out in various parts of America, it's still pretty late in America. You know, you're looking, what, 9:45? Yeah, 5 to New York. So yeah, it's 9:45. So they're all pretty late. And then cash open, and off it goes. It seems to me that the cash open move is reasonably clean, and it's the one you probably want to trade. Basically, break the overnight highs, and that's been the move on 2020, 2016. It did the same on Brexit as well. The one it didn't do the same on was 2008, but there was massive other things going on at the time. Last thing I'll point out on it is timings. I can send these over as an image. This was the odds as they shifted throughout the night, and where and when they started to shift. And that was then where you started to see various different reactions. So these are Eastern. So that 9:45, the period where the odds suddenly jumped towards Trump, that was that rally. So it seems that generally the market perception is Trump's good. At least it was last time. I don't see any reason why it wouldn't be this time. Biden was certainly seen as a better candidate last time than he is, well, he's not now. But the fact that even getting rid of Biden, who is now seen as a bad candidate, and replacing him has not seemed to change the idea that Democrats winning is not good. So just bear that in mind. The other big takeaway, and what almost everyone spent their time doing, was watching Betfair. The odds got it right. They did in 2016 as well. The odds on the night and the shift in the odds is a better indicator than anything else, it seemed. The only other thing to watch is the New York Times needle. They developed it in 2016, where it goes through a base case of this is the expected results, and then as states come in, it shifts the needle based on not just who's won what, but also the idea that if this state and these counties win, similar ones should also. So therefore it shifts the needle, and that because it's very obviously visual, a lot of people will watch that, and you'll probably see reaction as the needle swings. So that's something to watch. Right, we're going to have a little look at a bit more order flow in just a moment. On scenario like month end, you typically look to have one position and add to it rather than bank scalps on the breaks of low and re-entering on pullback. Absolutely, Jacob. The whole goal on a month end is that you increase your position all the way down. The good ones, and it's always easy to say, oh, the good ones, but the good ones, you have to play all of them like it's going to be a good one. And you have to accept that some of them you're going to add, and then it goes and starts to chop around you, and you end up in a situation where it goes across your average price. You have to start scaling out. You have to play it like it's going to be a good one, because when they are, you can add, and it keeps on going and going and going. The goal, simple, is to try and get your full size on. That's the main goal of it. Get your full size on, and then try and reverse at the bottom when it does the flick down at the end. If you can place some bids, the aim is to get flicked out and then long, and so out and then back in if it's gone down. So yeah, try and build. The danger you have, go and replay it, go and have a go at it. The danger you have in not trying, or in trying to scalp it is if you miss some parts of it, for example, that 47, if you were out and you tried to hit that, there's no way you're getting 47 or 46. So then you're selling 45 on the back of it already having done 30 handles down, you start questioning that. If you're short from up here and it goes rip through and you sell 45 and it moves your average price from, I don't know, 55 to 53, it doesn't matter, you won't notice it. But if you don't have a position and you now try and sell it there, you're getting pretty worried about that. Particularly as it did that drop initially, there you go, it traded about 40, all the way back to 44, all the way back down, back up. That's gonna get you really worried if you're trying to go in and out and in and out. If your objective is, I've got myself my position, I'm just gonna build, and then as you get towards the end, which should be somewhere around, there you go, that's 36, that's gonna be about mid 40s, that's the last 10 seconds from there. This is where you then start to place your bids towards the low. Put a bid at the low, put some bids below the low, try and get filled. That's the way that I try and do that. So yeah, try and just build the position as much as you can. You don't want to go in and out. Go in and out, you'll miss a lot. You'll end up taking losses that you shouldn't be taking because you're worried that it's going to rip back on you. Oh. Okay. I'm just going to go and have a little look at if there is anything going on in particular. Well, still got, oh, that oil position came back. It never got the break on it. So it did a little drop and then that was that. That's what it's done so far. So you got the 16 and then it did the roll back up and now back down. It's gone very stagnant as well. So this would be a time, this part of what I'm using order flow for. If it's not moving and it's not doing anything, yes, you could sell 16. That seems reasonably straightforward. And this is why I don't like getting too sucked into a chart. Broadly, I think it probably could still go down. You're inside of yesterday's range. You're not seeming to be bouncing out of this. So from a chart perspective, you go, yeah, I could sell 16. But yesterday's high was up here. So you have to look at it and go, well, I've still got to be selling 31 if I'm selling 16. I don't think there's enough going on there to want to be part of it. And these are the times where you have to just step back and go, well, I'm going to wait. There's nothing going on there. So now my two options are back towards 31 and see if we can sell there, see if it gives me anything, or trying to sell the break of 94. Either of those is going to be the main scenario for me here because there's nothing really going on. What you don't want is to go, well, yeah, go on then, I'll sell 19. You're now short 19, in 2-3 minutes time, it might still be at 19. You're losing the reason, or you're losing the kind of reason to be in the trade, your interest in the trade, and you start talking yourself out of it. There you go, so nothing's really going on. I bring it onto a, even on 1 minute, like your volume's very flat, it's tailing off, there's nothing really going on. Yes, it's gone on side, but that I think is luck. That's just total coincidence. You can click anywhere and you've got a 50-50 chance of it moving. So what I'm interested in, let's say you are short, is do we get some kind of change? Is anything going differently? Or is this a little move and then we go back to the same sort of stagnant type of order flow that we had before, which is roughly what you just saw. Just skip down and it's just stuck. So I want to see something different to have any kind of real conviction. And you could do this, as an experiment from an order flow perspective. Just open a market and click, or even toss a coin and click whatever it is, heads, long, tail, short, and then try and work out what you should do with the trade. Should you stay in, should you not? Because that way it starts making you ask questions about what's going on, rather than you trying to overthink from a technical perspective or anything like that. Just get in something and then see what you want to do about it. If you bought this, let's say you've tossed a coin, it's come heads, you're long 19, you could look at that and go, well, I could probably buy 11 as well, because it's not driving through 11. See what it does, see if it can actually get a bit of a bounce. If it breaks 11, because it seems to be finding a bit of range, 10 to 20, if it breaks there, then you give it up. If it doesn't, you stay in. But it's doing that same thing again, it's getting a little bit stuck. It's starting to tick down now, but again, when it ticks down, it's not doing it with any kind of force, it's just ticking down. It's very slow, very steady, and even when it has that little sort of pick up in pace, it does it and then it stalls. So like I say, if you're short, you're okay. If you're short from an order flow perspective, i.e. it was getting dull here, I'm going to sell it, it's a hard one to stay in because it's also now dull here. Whoops. is that really that much reason to want to do anything? Certainly I wouldn't want to sell it, which is what we just done. So then you end up sort of going, okay, well, let's give this one up and get out of 10. If you're short because your view is this is going down and you're happy with a stop in the mid 30s, you're fine. Stay in the trade. There's no problem with that. But if you're short just based on order flow, I don't think there was enough there. So I'd always still, when you're actually going to take it on as a trade, bring it back to what your overall view is and what you're trying to do. Otherwise, just go all out order flow, which is something that I'll give you guys a challenge to do later on, of no charts, just trade. You'd be surprised how good you are. Particularly after a week of doing order flow, people will start picking up little things, you'll start to understand. But the main thing I would say to most people from that perspective is try and understand where the range is. We've seen it trade down to 9, whoops. We've seen it trading up at 20. You could look at this, just go, well, I didn't really need a chart for that. We saw it trade here, we saw it trade there, we've seen it trade back. You can now sell 20 and just try and play this up and down the range. One thing that Jigsaw does, which I know people have talked about before, on this example, I sold 19, then I sold 10, and then I got out of one at 10. So it's now showing my price at 10, because what it does, it takes off the first in, first out. It's really annoying, because in my view, this is just an average price of 14, and I've got something out and I'm willing to get back in. I don't like the fact that it moves like that, personally, because now it looks like you're in trouble, rather than you're going to keep yourself in the trade far better if it shows it at 15. And so the way I try and think about that is mentally, I'm short 19. I sold 10, it didn't work and scratched it. I'm still short 19 mentally. A good challenge if you want to try and do that and test out your kind of ignoring your average price. It's a good one to try and do in the bonds. Go and put on a Bund Schatz spread or a 10-year, 2-year spread and just leave it on. The idea there being, so let's say you're in a Bund Schatz spread. You're short 3 bunds, or sorry, yeah, short 3 bunds, long 15 Schatz. Just put that on and leave it for a day. You're going to come back at some point and one of them's miles on side, one of them's miles offside. So now, whenever you trade, let's say you're trading Bund and you fancy buying it, you can buy, but you then have to get out whatever you just bought. So you're short 3, that's part of your spread. So whatever you do, you've got to get back to 3, short. By doing that, you completely ignore what your average price is, because your average price is irrelevant. If your average price is your short Bund from 50, but on your spread, that's fine. But now you trade, you think, oh, this is a good buy. You buy 3, so now you've got no position. You've got to get back to 3. But if let's say you buy 3 at 10 and it trades 20, you've made 10 ticks and now you're back in your spread. Think about it that way, it completely takes away this whole worrying about first in, first out. You're seeing this as 2 completely separate things. So it's a good challenge if you want to try and view things like that. But this is very much just stuck here, it seems. At some point, you'd expect it to start to put in a bit of pace. It will start to move somewhere. That'll be the change. But at the moment, it's just rotating and accumulating positioning. Some people are getting short, some people are getting long. And even there, it gets some pace towards the low, but you need to see that change here, not in the middle of the range. That's just the case that some people stopped buying it in the middle of the range. A few people sold it, and that's that. It's a pretty stagnant oil at the moment. See if S&P is doing anything different.
Not much. It's slowly S&P today.
Yeah, I'm not surprised. Like, why should you be surprised about this at the moment? You've got the election coming up tomorrow. This isn't because I'm saying, oh, everyone's just going to stop and wait for the election. It's part of the fact that a lot of people are not going to be in today in order to trade the election. Yeah, they're going to take a break, make sure you've got your sleep right, do your reading, do your planning, all of that side of things. It's you've got to kind of weigh these things up of how much value are you getting out trading today versus not being fully focused on election night.
Made some notes, so it's a good.
Sorry?
I made some notes while I was watching this, so it's valuable.
What, on the election?
No, just today.
Yeah.
Would you say it's quite thin as well, Richard?
Quite thin?
Yeah.
S&P, I wouldn't say wildly thin. It's maybe a little bit. That's something, that's kind of thing at the end of the day.
Is this today?
Yeah, this is today, this is what's going on now. It's kind of thing at the end of the day, write those types of things down. Yeah, whether you felt it was thinner than normal, more volatile, less volatile than normal. That way, you start to track the changes in those types of things. Sorry?
It's got good smoking. It's not good.
No. That's the problem. It's just the smoking. Yeah, I think we're probably not going to see a great deal of interesting order flow today. It's going to be slow, it's going to be steady. Get your replay set up. Go and have a go at some parts of the election from last time. The election's a tough one to replay because there's not a moment in time where you say, yeah, that was it. But it could be worth going back and having a look at some of it. It's also going to be trading in slightly different fashion because of the liquidity at the time, as in it was thicker than it is now. Go set your replay up, go and have a go at that. What I'll also do is I will send over, I'll put it in the materials section again, a PDF with, I don't know, I think there's about 30 or 40 different examples that I've kind of accumulated over time. I've not updated them, I must admit, for this year, but there's a large number of examples of different types of action in different markets, going back to like 2017, so you can see super low volatility going through super high volatility. So I'll send all of that over, and you've got various different replays to have a go at. Finally see an order break. There we go, that's better. That's what you want to see. Bit of pace coming in. You want to see that then continue. So, like I said, you knew something was going to happen because it just traded there for ages. It just builds positions. They've hit them through there now. You don't really want to see the volume die like that. But as long as it doesn't come back above 10, you're okay now. I'd kind of try and, what I'm trying to do is always look at things in little ranges. This is trading 10 to 20. Now you're below 10. Your resistance is 10. Where's it going next? Where's the new low? Still with the overall view that it's going down to go and fill that, or at least test those single prints towards 85. That's the bit I'm really interested in. But I'd be feeling much more confident now that you've actually seen that surge of action. You want to see this now translate into something more. So there we go. Something to watch for the rest of the day, how oil reacts around 10 and what it does also when it gets down towards 80. On that note, I'll wrap it up there. Get your questions in for tomorrow. The other thing as well, if you see anything on a ladder and you think, I'm not sure what that is, I don't know how to interpret that, make a note of the time, but be specific. Don't go, oh, it was around lunchtime yesterday, because I can't replay an hour to find that you thought you saw someone flip and that was it. So be specific and we can get them up and we can go and have a look at what happened. I can replay anything you want from any time you want. So let me know and we can go and have a little look. Right, on that note, I will leave you guys there. Have a wonderful evening, and I will see you all tomorrow. There used to be a sofa in the gym, but it disappeared. That's gone.
Do people still use the gym?
I think some diehards still use it a little bit, but
It does help when you exercise before. I noticed you do feel more focused and clearer.
oh, massive.
Even just a couple of push-ups or something.
Releases endorphins. Gets your blood flowing. Pipes up. Yeah, absolutely, it makes a difference. There you go. Should have had a bit there. Just what I was about to do. So it's just all changed as soon as it picked that volume up.
I've been watching it though, and it felt like, even though it was slow, that they just was sort of almost keeping it there. You know that sort of feeling sometimes?
Yeah.
All of a sudden, it just does it.
Yeah, like I'd always lean towards the short there, the fact that it's already moving down.
Yeah. Coming back inside yesterday's range sort of thing.
Yeah. No, it's interesting. Pretty much on the turn of the hour. That.
Yeah.
I've definitely always been someone who believes in whatever you want to call it.
Yeah.
You get that. Just trying to make something happen, isn't it?